This is Real Generational Wealth. Live from Southern California, this is Abby, Espy, and Jen.
Hi, everybody.
Hello.
What's up, everyone? And welcome back to Real Generational Wealth, where we have over 50 years of combined experience making sure you and your family always have a place to call home. We're excited about today's episode because it's the first of our two-part series where we'll be walking you through the pre-approval process so we can get you one step closer to becoming a homeowner in 2021. So stay tuned because we have a special guest lender here who's going to talk more about loan options. So remember, if you're watching live, hashtag live in the comments below. And if you're watching us on the replay, hashtag replay. I know last week we had a great episode, and it turns out a lot of you have a ton of questions. So remember, we always welcome your questions. Please put them in the comments below. But it seems like overall, most buyers have the same questions. Which loan has the lowest monthly payment? What options require the least amount up front? And what will it cost? What will cost me less over time? Which loan type is suitable for my credit score? How does my income affect which loans I can get? And the list of questions can go on. But the answer is there is no right answer because it depends, which is always why we advise our clients to talk to lenders to get pre-approved. But what's the difference between a pre-qual and a pre-approval, Abby?
Okay, so pre-qualification or pre-qual, that's when you submit an application and then the lender will go by what you have on the application, but they haven't verified any of your documents yet. However, so the difference with the pre-approval is a pre-approval is more extensive. The lender has reviewed your W-2s, your tax returns, and when you're submitting an offer on a home, it makes you look like a much stronger buyer. So if you're just submitting a pre-qual, it's like, the lender hasn't really verified the information. But if you're submitting a pre-approval and it says, all of the things that the lender has verified, all of the documentation that they received, it makes you look like a much stronger buyer. So SB, what would you say is the best way to increase your chances of getting pre-approved?
Well, first of all, you need to find a good realtor and a lender that can work hand in hand to coach you and to help you on the pre-approval or pre-qualifying stage of the loan. So that is very, very important because there's three factors that are really important when you decide to buy because what they're looking for is your DTI, which is your debt to income ratio. A lot of people are thinking about FICO scores. The FICO score that you hear out there is different from the FICO score that we have when you're doing a mortgage loan. So you also need to have your credibility. That means you need to have a job. You have the capacity to borrow. So a sturdy job. And number three is that you have a source of down payment, whether it's a gift, whether that is from your 401k or your savings. So there's that is very important to know that you have those three items in place. Okay, so when you have a loan officer that works with you, they would be able to coach you on how to go about those three factors and if there's anything that you need to fix or prepare, then they can do that even before you take a look at houses.
Right.
That's the most important thing. So there are different lenders out there. There's mortgage broker, direct lender, big banks, the big banks as we call. We have like Bank of America and Wells Fargo,
Chase, Wells
or
Fargo.
direct lenders. We have direct lenders
Credit
too.
unions.
Yeah, and brokers. But the bottom line is that that lender needs to be able to have spend time with you, coach you, and walk you, hold your hand, and make sure that you can understand exactly what you're doing and what you're getting into. So basically, it's like riding a horse with your realtor and your loan officer, and the three of you are in sync. So that's the most important thing when you're buying, whether you're buying your first home or you're buying your first building, your first investment home. It is important that your team is all together intact and you are in sync.
Sounds
It's the
good.
perfect word.
Yeah. So
It has to be a
today,
team. It has to be a
Have to be
team
in
effort.
sync.
that's right. Yeah, yeah. So we're excited to introduce to you a lender. Actually, his name is Oliver Flores, and I've been working with him for the last 10 years. And I am really proud to share his skills here at the Streamline today. So, Jen, what about if you bring in Oliver?
All righty. What's up, Oliver? How are
Hi,
you?
Oliver.
Hi, Jen. Hi,
Hello.
Abby. Hi, SP. Nice to
Hello.
be here. Thank you for inviting me.
Yeah.
Of course. So, why don't you tell our viewers a little bit about yourself? How long have you been in lending?
So, I've been doing lending for about 20 years, and I started working with first-time home buyers, and and then I transitioned over to the older generation, which is like the reverse mortgage. We're not going to get there, but I do have to say, okay, that I like what you guys are doing in your show, the three generations that you are working with. You have because I think that each generation, the millennials, the Gen X, and the boomers, have their own specific strengths and weaknesses.
Right.
So I
That's
like what
true.
you guys are doing here, that you guys are helping these folks that may, let's say for a millennial, okay, maybe the down payment would be maybe an issue. The Gen X, they have the down payment and they have the job. So they're in A-okay. The boomers, okay, the they don't have income anymore, but they do have equity in their home, things like that. But they want to help their kids maybe to get into another house, right? So
Mhm.
it all ties in. It's all see. Real estate is about you can build wealth with real estate. I think all
Real
you three can agree
generational
to that,
wealth.
right? And you can if rich people, okay, and not even rich people, okay, folks that want to build wealth, they own real estate,
That's true.
That's true.
right? So
Every
and
millionaire owns some kind of real estate.
some kind of real estate, right? Some
Yeah.
kind of real estate, whatever it is. It could be a small condo, it could be something, okay, but that's how you build wealth.
Yeah, I've never seen a millionaire that was renting.
Good point,
It's
right?
true. It's true.
Yeah.
Yeah.
Good point. So I like what you guys are doing here, and you're helping them show them the way. So one of the things that most first-time buyers, I mean, you got to start somewhere, right? You have to start somewhere, and that would be your first-time buyer. Most of the first-time buyers, they're looking at where am I going to get my down payment?
Hmm.
That's the number one question.
Right.
It's actually not the most important question. I found this out when I was trying to buy my own house. I mean, I wasn't in the business then, but I was trying to figure out. And then people are trying to be creative, seller financing, this like that. Okay, I was getting lost. Okay, I just needed to know the right people to help me get into my first house, and that's a realtor and a lender,
Yep.
That's right.
right? So, okay, so first time buyer, okay, they need down payment, right? But actually, the biggest problem a first time home buyer, or actually any buyer, okay, is really credit. You have to have the credit,
Mm-hmm.
right? You have to have, it doesn't have to be a perfect credit. For instance, okay, let me kind of expound on that, on the type of tools that I use to help people,
Okay.
right? So, and that's what I do. Okay, people think, oh, I just get applications, things like that. Okay, that's not what I do. All right.
No,
My job is to give you a fighting chance to get you a loan so you can get into your house.
the best loan.
That's it. That's my job. I don't just take orders. Okay. Now the underwriter is the one that is deciding if they should give you the money. Now, if I did my job right and your realtor helped me out, then I can get your file through underwriting and you got yourself a loan, hence you get yourself a house.
Mhm.
Nice, huh?
That's
All
right.
right.
Yeah.
All right. So what tools do I use to help you get into your first home? Well, I use loans such as FHA, VA, conventional loans. And I'm only mentioning these. Okay, there's other loans out there. Okay, but 9 times out of 10, first-time home buyers, they're going to use these three.
Right.
Okay?
Yeah.
Let's
So,
not get
okay,
exotic.
so
Staples.
Right.
right. So then let's explain a little bit about these loans. So what are these loan types? What are some of the minimum down payments you need and credit scores required for all of them?
Okay, so let's hit up on, let's say, an FHA. An FHA and a VA. These are government-backed loans.
Yeah.
So let's start with a quick one. Okay, VA. Okay, VA, as long as you're a vet and you are discharged honorably, you can qualify for a VA loan. Okay, 100% financing. So that means zero down payment and no mortgage insurance. Mortgage,
Awesome.
what that is, okay, we'll go to that on the next episode. Okay, basically, a mortgage insurance is if you don't have the down payment of 20%, you're going to pay mortgage insurance. Okay,
That is the insurance for the lender to protect
Right. So-
them just in case you walk.
right. So, but I could expound more on that on a different episode. Now, so that's your VA. Okay, so your VA. Okay. So FHA. Let me go to FHA. Okay, so FHA, you can put down as little as 3.5%.
Mhm.
3.5%. So with VA and FHA, there's what we call a conforming limit. Okay, so a conforming limit is the maximum loan amount that you can get on an FHA on certain areas. Okay, for instance, okay, in general, conforming limit for an FHA is,
Let's say here in LA County.
well,
Yeah.
in general, the conforming limit for an FHA is 548. Okay,
That's the maximum.
that's the maximum.
548.
However,
Loan amount.
loan amount. That's a loan amount.
Okay.
However, okay, if you live in a high balance area, that maximum loan amount becomes 822. Okay,
Like
now,
Los Angeles.
so, but these limits, they change depending on what county. For instance, let's say San Bernardino, okay, the maximum loan limit over there would be 477. Okay, LA County, that's a
High balance.
high balance or high cost area, so that would be 822.
Mhm.
Okay, so that's your FHA, and that goes along with the VA too. Okay. Now, what type of score do you need to get into a FHA? Well, you're going to need a 600. Okay.
600
And on a
credit score.
VA, you're going to need also a 600. That's conforming. Okay.
Wow.
But it's in conforming. Okay. But if you are looking at a high balance and thinking of using an FHA, you're going to need 620.
Mhm.
Okay, but check this out. Okay, on a VA high balance, if you have a score of 640, you can have a loan amount of 1 million.
Wow.
Wow, that's a lot.
Right, and if your score is 700 with 5% down, you can go to 1.2.
So Oliver, we have, there's three big credit bureaus, right? You've got Equifax, Experian, and TransUnion. Which credit score do they use? Do they take an average of all three, or?
No, we don't use the average. We take the three and we get the middle of the three.
Right.
Okay,
So the mid
that's
score.
right. So we take the middle of the three, not the average. Okay. Now, so that's your government-backed loan. You also have your conventional
Oh,
agency
I have a
loan.
question before you get to conventional.
Sure.
So, are you saying that if I'm a VA, I have 5% down, it can be 1.2?
Yeah.
So, does that mean that that would be my purchase price because you said it's 100% financing? Or
Well,
are you incorporating, adding on there the closing costs?
now the only closing cost that you could add or finance into these government-backed loan is this what we call an upfront mortgage insurance. And I can that's another avenue that
That's a whole other
we're
episode.
going to be here for a while if we go in that direction. Okay.
Mhm.
But when you're looking at a VA with a 5%, so it's going to be loan amount of 1.2, right? That's your maximum loan amount. So it's your purchase price minus the 5%, whatever's left, 1.2. That's it, loan amount. Okay.
So, are there any additional costs associated with a VA loan? I know there's like a funding fee.
That would be the upfront mortgage insurance that goes along with the FHA also.
Okay.
Okay, so the government-backed loans have that.
Yeah,
Okay.
you have that upfront cost. Okay.
Can the lender cover that upfront cost?
No. Okay, so it's fine, but it is financed into the loan. So you don't come up
Oh,
with
I
it.
see.
Okay.
So it
So that
adds
means that
increases the loan
I'm
value.
going to be looking, if I find a house that is for 1.3 or 1.4, can I still get my EVA loan?
Well, if you're
Or do I
looking
have
at
to borrow for a house that's 1.2?
if you're looking at a higher price home, okay, in that ballpark, maybe you should be looking at a jumbo loan.
Right.
And I mean, you start thinking, okay, well, who are these people that can buy these $3 million homes? Well, they're not using VA, they're not using FHA, they're using other types of financial tool, right?
Mhm.
And to be honest, okay, I've never done a first-time buyer that bought a 3 million.
No,
Never.
1.3. I said, because like for instance, here in Sherman Oaks, first time home buyer, a single family home here is about 1.2.
All right.
Okay.
Okay.
So if a 1.2 single family home, can I use my VA to buy that home? Single
You
family.
can, you can, you can. Um, so as long as it fits the maximum, you're okay. But just think about the higher the purchase price, the higher the mortgage, the higher the
course.
taxes.
Mhm.
And I can even later on, maybe I could give you an idea what monthly payments would look like. Okay.
Yeah.
So kind of remind me. Okay.
Yeah.
So that's your government loans. Now, if we look at the other side of this, okay, this is going to be the agency. These are like the Fannie Freddie loans. Okay. So the agency loans are your conventional loans. So again, okay, you have the conforming loan, okay, which goes up to 548,000, okay, and then you have a high balance again, okay, 822, okay. Now these type of loans, they're not backed by the government, so they're a bit more risky for the investor. So now you're going to have a higher requirement as far as credit score. So from 600 on an FHA, on a conforming, they require 620. Okay.
Not
That's
too much
too big a
higher.
difference. Yeah.
Yeah.
Not too much higher, right? And then on a conforming, you can go as little as 3% down. Okay.
So
And
less
if
than
it's a
FHA.
if it's a high balance, however, you need to put down 5%.
Mhm.
Okay,
So
5%.
you only need a 620 FICO to qualify for a 3% down?
You need a 620 to qualify for a yes, correct,
Conventional. On a conventional.
Okay.
on a conventional. Now, people are kind of hung up on the score. It's not really just the score we look at. Okay, great, you got the score, but we also look at the whole credit profile,
Mhm.
Right.
right? So it's not just, oh, I got a score, it's an automatic. No, it's not. It doesn't work that
Right.
way.
Your
Okay.
DTI and everything.
Right. Well, not only that. See, now we're talking about capacity to pay for the loan. I'm just talking about credit. When I pull somebody's credit, I don't stop at the credit score. I look at what's happening. Are there lates?
Mhm.
Right? Are there any lates? Are there any other mortgages on there? Maybe they co-signed for somebody.
Mhm.
Okay, so these are there any
That's usually in a
judgments?
Filipino family.
Yeah, a lot
You're
of
creative.
Filipinos,
I
we
need
like to
for cars.
co-sign on
I've
cards.
seen that a lot.
But here's the thing, okay? People are hung up, like I said, on the credit. The one debt that could actually hurt you is buying a car.
That's right.
Okay, buying a car, sure, okay, it's just gonna ding your credit, but the way it affects you is in the payment.
Right.
The payment, because now your debt to income ratio is going to be affected by that $600 a month payment. Okay.
Yeah.
Your score is still fine. Your score is, let's say, 640 or 680, but your debt to income ratio is going to be hurt. So I heard SB in the beginning, she was talking about the DTIs, debt to income ratio, credit, and things like that. When we pre-qualify somebody, we look at four items on the application. Okay. Number one is their capacity to pay for the loan. This is where that DTI comes in. Okay. We figure out how much you make annually in your employment. Okay. That's your capacity. Number two, your credit. So we look at your credit, and as I mentioned, we look at not just the score, but also the profile. That's your second one, okay? And then we look at your cash, your down payment. So how much are you going to have for down payment? Where is it coming from? Is it coming from your IRA, from your checking savings? Is it a gift? So that's the third one. And of course, number four, you don't have it yet. That's the collateral. If you probably noticed, they're all C's: capacity, credit, and cash, and collateral, right? So we call them four C's.
Collateral is the house that you are buying.
That's right.
Yeah.
That's right. And, that comes when you go into a purchase contract, when you're in contract. But for, I think Abby mentioned what's the difference between a pre-qual and pre-approval. On the pre-approval, we look at the three: capacity, credit, and the cash. Okay. So just to give you an idea what that looks like in terms of numbers, let's say somebody wants to buy a $500,000. That's a good number, right?
$500,000.
Round number.
Yeah. Okay. So that's a good number. Okay. And I'm just going to use, let's say, an FHA. If somebody was to buy a house using an FHA, they need to put down, say, 3.5%. I'm going to just grab my calculator here. All right. So somebody buying a $500,000 home.
They need a 600 credit score.
What's that?
They need a 600 credit score.
Right. So 600 credit score, right? So 500, right? And then 3.5%. So that's going to be about 17,000.
Sorry, guys.
Right. So that's 17,000 for the down payment. Okay. So when you buy a house, you don't just put down the down payment. There's also closing costs associated in the transaction. Okay. So you need to save up for the down payment and then the closing costs. Now, the closing costs, there's a list, and I'm not going to break down the list because it's a long list. Okay. Yeah. And it varies from the type of home, when you're closing, what area you're closing. So it varies. Okay. But in a nutshell, I like to use, let's say, 2 or 3%. So for a $500,000 home, that would be about $10,000.
Right.
Right. So let's add this up. Okay. So if you had 17,500, and then you have a closing cost of 10,000, so now you have to come up with 27.
But so could you roll the closing costs into the loan?
Not on a purchase. On a refinance, you can.
Okay.
Okay. Now the only piece of that closing cost that you can roll into is the upfront mortgage insurance. Okay. This is an FHA. Okay. So that you can finance into the loan. But let's say processing
closing cost.
I'm sorry?
How about the non-recurring closing costs? Title fees,
No, you
appraisal.
cannot. Not on a purchase. You can do
But,
that on a refi.
I think that's you guys, like, or Guild Mortgage, because I always do that. Like on my transactions, I have the closing costs. I have the lender roll in the closing costs so that the buyer just comes in with the down payment.
Now the closing costs, reoccurring, non-reoccurring, the you can only do that if you have a special program attached to it.
Yeah.
Okay.
Okay, and we can go into special programs in a bit here. I think you mentioned it earlier to me too. So somebody, okay, going back to our example, somebody buying a 500. So what's the monthly payment of something like that?
Yeah.
Just so your viewers can have an idea. Okay, how much can I afford? Can I even afford that? Right. So let's say we're going to use 2.875. Yeah, just for the sake of example,
For interest rate.
2.875, 30-year fix. FHA loan. Okay, so the monthly payment on that, principal and interest, is going to be 2001. Okay, now you're going to have to pay property tax on this property that you just bought, so that's going to be about 521. Okay, now you're going to have mortgage insurance because you did not put down 20%.
Mhm.
So that's going to run you about let's see, 348. Okay, then you're going to need hazard insurance or
Insurance.
fire insurance, which is the same. Okay, let's just say it's $100. Okay, overall, okay, if you got to add all them up, you're looking at about 2,900. So there is your mortgage bill for each month.
So is there an
2,900.
option? Is there an option to roll in the mortgage insurance? Like I've heard of lender paid mortgage insurance, and we've done that before too. So
You can do that on a conventional,
okay.
Not on an FHA.
not on FHA.
So does the borrower have to pay the PMI, the mortgage insurance, throughout the life of the loan?
On an FHA, you do have to pay it through the life of the loan.
Okay.
But on a conventional, if you bring down the balance down to 78% of what you started with when you bought the home, you can actually request for the mortgage insurance to be removed from the lender without refinancing. Okay?
Nice.
Without
Okay.
refinancing.
For an FHA, I can refinance my FHA once the value of my property goes up, right?
Correct. Yes. So so you have either refinance it or you could bring down the original balance to 78%. Okay, on a conventional. Okay. So
Okay, so I was
go
going to say, so our example was, so for a $500,000 house, it was 3.5% down, about 2% for closing costs. I didn't know what the total was for that. Just so
About-
our
about
viewers can
10,000.
kind of, okay, so about 10,000, and then and the monthly's looking at about, what was the total you said? About 2,800,
about
2,900.
2,970 somewhere. Let's just give it a round
Let's
number.
say 3,000.
Right.
Okay, so that's with an FHA loan. So is it different if you were to get it with a conventional, say 5% down?
It's going to be similar because it's the only difference between the two is because you're gonna pay principal and interest the same, right?
Right.
The taxes is going to be there too. Now the mortgage insurance, this is where it gets a little tricky. Okay, the mortgage insurance could be more or could be less, and I say that because it depends on your credit.
Mm.
Okay, it depends on your credit. So obviously, if you have good credit, then you're going to pay less on mortgage insurance compared to somebody who doesn't have good credit, obviously. But so when a home buyer comes to me and can you qualify me? They don't pick. I want this. I want that. It's not a buffet. Okay. I'm going to figure out what's the best option.
Right.
Is the FHA. Obviously, if you're not a VA, okay, that's out of the table really quick, right? So I'm just going to be looking at FHA or conventional, right?
Mhm.
So if your credit is good, I may just take you to the conventional side, okay? Versus somebody that has credit score of 600, right? Now I'm going to take you to the FHA to make it work, right? Now let's say, okay, well, you know what? I have 10% down. Okay, well, I'm going to take you to the conventional side, okay? But now I'm looking at, my debt income ratio is super high. Even if it's 5% down, actually, no. If debt income ratio is too high, I may just take you to the FHA, even though you have good credit and if you have a down payment of 5%. Right? So it's a case by case. Nobody has the same.
Because usually FHA is more forgiving.
It is
more flexibility. They are, they're more. They're not as stringent as the conventional.
But I noticed FHA, the mortgage insurance is higher than conventional.
If you have a borrower that has really good credit. So if I compare the FHA and somebody that has a good credit, then yeah, FHA is going to be higher as far as the mortgage insurance is concerned. And just to give you an idea, let's see, I think I made a little note here. So as far as scores, somebody with a 600 and a 620 FHA, okay, is considered you can get a loan, decent. Okay. And if you have a 621 to 640, that's actually okay. Okay. Anything above that, okay, it's treated the same way. Okay. Now on a conventional, if you start with 620, it incrementally gets better. If we increment the score by 20, your terms get better. You may get a better interest rate, you may get a better mortgage insurance. If we increment it by 20 for 600, 620 gets better, 640, 660, okay, all the way to 740. Once you hit 740, that's it, the top.
It's the same.
The same. If you have a 740 and then somebody comes in 800, you guys get the same thing.
So the MI is going to be the same rate?
Yeah. So somebody who has a credit score of 740 and somebody with 800, they're going to get the same MI, same rate. And of course, rates depends on when the rate is locked.
Yeah, it fluctuates every day.
It fluctuates.
Explain that. Explain the difference between explain the rate lock.
Okay. All right. Okay. So when you get pre-approved, you actually are not promised a rate. Okay, you're not exactly going to get that rate. But we need to figure out a way to see if you qualify. So we use like the going rate that you might get. Okay, so that's the rate we qualify you on, and we float it. You're not committed to that rate, and we're not committed to that rate. Okay, so that's what we mean by floating the rate. But once we lock the rate, now we're committed to delivering that rate to you. Okay, it protects you from the upswing and the downswing in the market. Okay, so
how long does a rate lock? How long does that lock typically last?
It typically on a purchase 30 days.
Okay. Or you can extend it sometimes if you go over like a 45-day escrow. Sometimes they can extend it, or you can extend it with a little fee, right?
Right. And when you talk about rate locks, you can't just tell your lender, hey, you know what, can you lock it right now because the rates are good? Not really. If you don't have a property, you can't lock it.
Okay, so you have to be an escrow.
Yeah.
You need to be an escrow.
See, the rate lock is attached to an address, not to a person.
Oh, good to know.
It's attached to a collateral.
Yeah.
So you have to have an address.
Okay.
So that's how the rate lock works. Now, if sometimes you might hear, okay, hey, can I buy down the rate?
Right. I've heard that.
Buy down the rate. Okay. What does that mean? Okay. So So let's say you started off with today's rate, okay, 2.875. Okay, now 2.875. But if you pay a little money, what we call a discount fee, you can bring it down to, let's say, 2.625. Okay,
Are discount fees the same as points?
they are. All right. So discount fee and points are one and the same.
So this would be paid with your closing costs.
This would be paid for your closing costs.
Part of your
Now,
closing.
if now when you're buying the house and you have, let's say, a motivated seller that's willing to help out, they can actually pay for that.
I don't see that. I don't ever see that.
Well, I've
I guess
seen
it
where
depends on the market, but
It
with
depends
multiple
on the
offers,
market.
it's
it does
like,
depend on the line. Yeah, because I've seen
yeah,
where
it doesn't happen very often.
I've seen where sellers give a credit, right? Like let's say you're in
Yeah.
escrow and there's repairs or whatever,
Or
and
repairs.
the seller gives the credit to closing costs. And so I've seen where the buyers say, I have the money for closing costs, and then they use that towards buying down the rate instead.
Right. So
Okay.
Yeah, that's what I've
can
seen
get-
more often than. Yeah.
Yeah. So it really depends on it's case by case scenario, right? I mean, maybe
Right.
not in one market, but maybe on another market. It depends on the property. So
Shape.
it depends on how motivated the seller is, right?
Yeah.
So, but there is a
Right.
maximum amount that a seller or an interested party can pay.
Mhm.
Which
Yeah.
is it like 2%, 3%?
6%. Actually, 6%.
Oh, it's 6. I've only heard
lot.
3.
I didn't know that.
Okay, but no seller in their right mind is going to give you 6%.
I know, because
Yeah.
doesn't it affect the appraisal? It's like your home has to appraise for 6% for the seller to net the same amount.
Right. So I've never seen it. Usually, I would just see like maybe 2%.
Right.
Yeah.
To credit the home buyer, and you can use that towards reoccurring and non-reoccurring closing costs. Let's see. What else do you guys
Recurring and non-recurring closing costs, Oliver?
say again?
Just for the sake of our audience, what is a recurring and non-recurring closing cost?
Okay, so your one-time fees are your non-reoccurring closing costs. Okay, so at the closing table, you will get a statement from your escrow officer, okay, listing down what you need to pay, such as title insurance, settlement fees, okay, escrow, okay, lender fees are going to be about maybe $1,000, okay. So recording fees, okay, these are one time. Okay, these are one time. So the reoccurring ones are the ones that are prorated interest. Okay, so if you're closing your transaction in the middle of the month, well, your next payment's not going to be until the following 30 days, right? So you need to, so the 15 days that you're going to own the house that you move in, you got to pay that ahead of time. So that's your reoccurring. That's part of your reoccurring. So, and then if you have also, not if, you're going to have an impound account.
Mm-hmm.
What's an impound account? Okay.
Yeah.
All right. I know you guys are going to ask me what's an impound account. All right.
I know what it
So-
is, but I don't know if the viewers know what it is.
All right. Think of an impound account as a savings account. Okay. Think of an impound account as a savings account, but the only purpose of this savings account is to pay for your taxes and an insurance. Okay. So think of it as a savings account that pays for your taxes and your insurance when they become due. Okay. So when are these due? Well, if for your property tax, it's due in February and in November. Okay.
Oh, not April or December?
Now that's late if you pay.
That's when they're late. Yeah.
They're going to charge you a late fee. I see how you operate. Okay, so you pay your property tax biannual. Okay, so what the lender does is they set it aside for you, and they collect it from you monthly. And remember that savings account I told you, that impound account, they put it in there. So they put it in that saving account, And yes, it's getting dividends. And if you earn some dividends, they'll give you the check, okay, or they roll it into your balance. So it's yours. It's not theirs.
Right.
Isn't an impound account also called an escrow account?
Exactly.
Yeah.
It kind of serves like escrow, like it pays things on your behalf.
It's a neutral account. Yeah.
Yeah.
Right. So that's your property tax is impounded, and then you have your insurance is also impounded. Which insurance? That's your fire insurance. That's renewed every year, once a year. When you close. If you close in December, so it's renewed in December. Okay.
Right.
So it's collected and it accumulates, and then they use that money to pay the 1 year policy in December. Okay. So
Okay.
those are your reoccurring closing costs. So you got your non-reoccurring and then
Your
your
recurring.
reoccurring.
I had a question. When you were talking about FHA, like I know when I get offers, it's when I see FHA versus a conventional loan, I kind of favor the conventional loan more. Can you explain why it's more beneficial to have a conventional loan when you're buying a home?
Well, to some buyers, it's not much of a choice,
Right.
really,
Mhm.
because just they don't have that option.
Mhm.
And that's because maybe their debt to income ratio is too high, so we have to go into the FHA side, and the conventional is not an option. But let's say somebody does have that option. If the numbers favor or benefit the home buyer, yeah, why not go to the conventional side? Maybe the interest rate's lower. Okay, now it depends on the seller on accepting their offer.
Right.
But
Right.
there's also additional requirements with FHA, like HVAC, like things like that. Whereas conventional, you can kind of get away with certain repairs not being made. Like FHA
Yeah,
has
yeah.
other requirements.
Right. So from the seller's perspective, and the buyer, your home buyer should be aware, okay, that yeah, FHA is not really the favorite. Okay, put it this way, okay, you have your conventional as your favorite, okay, then you have your FHA, okay, and then you have your VA, okay.
Yeah.
Unfortunately, okay, which is kind of sucks because I think one of the best loans out there is a VA, and if you have some vet here,
On
thank
the
you.
for the side of the buyer. In
Right, I mean,
favor
I
of
think
the
we owe
buyer,
the vets actually.
of course.
So
Yeah.
Does it take longer to close escrow on a VA and FHA loan because it's a government-backed loan?
no, it doesn't really. But what it does is they're more strict as far as the collateral review
Okay.
goes.
Mhm.
Makes
Okay,
sense.
so they see FHA protects the home buyer
Mhm.
more so than a typical conventional. Okay, so they require certain things to be repaired. So sellers, of course, they don't want to pay for the repairs. They prefer the conventional,
Right.
Yeah.
right? So and it's even stricter on VAs because some costs cannot be paid by the VA buyer.
I see.
Mhm.
So in a sense, okay, it puts some second fiddle, so to speak, okay, when you're competing with
Bargaining power is compromised.
Or
right.
you're in a weakened position, I would say. But if you put a couple thousand in the sales price, then I think sometimes the seller
Right,
can
and
negotiate it.
this is where you need to have a good realtor. So remember, my job is to get you the money. Okay, your realtor's job is to help you get the house.
Right.
So you need somebody with strong negotiating skills, not just somebody, okay, that has a license, right?
Yeah.
That's what makes a good. See, that's what makes a good realtor. Okay, you need somebody that, and I hope your viewers do this. Okay, they interview. They should interview the realtor. Okay,
Yeah.
before they sign up. Okay, you if you don't trust your realtor to give you the best price, the best options, well, maybe that's not the right person for you.
Yeah.
So you really have
True.
to work with your realtor. Okay, and like you said, okay, yeah, you're at a disadvantage, But if the right realtor knows the right people, okay, and they're working with the right lender, okay, and yeah, hopefully it's me, but it's not me. It's okay, okay. I'm okay with that. But working at a professional as a team, can get the job done. Okay. I actually, let me tell you a story. One of my client, this was probably about 6 years ago. Okay, she is living in a two-bedroom house. Okay, a family of 5. Imagine this. Okay, family of 5, 2-bedroom. Her son is mentally disabled. Okay, she has a teenage daughter, a teenage son. Okay, 2-bedroom house. I visited them, actually. I went there. Okay, before, this was 6 years ago.
That's too small for them.
Too small. Okay, and imagine, okay, a teenage girl, teenage boy, and a disabled child. Okay, living in a 2. You know how hard that is? And she thought, okay, she could never get a house. Okay, she was just wishing. Okay, well, guess what? Okay, she really didn't have much money. Okay, but at that time we used a program called CalHFA. Okay, at that time they would help with the down payment and the closing costs. Now, programs do change. Okay, so some of the assistance program out there, okay, some of them have gone away, some of them have cut down. Okay, so sometimes you just have to take advantage of the opportunity at hand, and she did. Okay, she wasn't working at the time. She used to work at a department store. She left because she had to take care of her son. Okay, long story short, okay, she was able to get into a house, and if I remember correctly, it was like, I don't know, maybe less than 300. Okay, now that same property is worth more than double than that.
Wow.
And yeah, so we're looking at maybe 600 something. Okay.
Wow.
But here's the thing, okay, when you guys talk about generational wealth, this is what your show is about, right? She is going to use the equity on that house to help her children get into their home, leverage the equity to help her kids get into their own homes. Okay.
Wow.
And
Amazing.
and
Darn style.
right, and she may even do a reverse mortgage, because she's at her age where she's about to retire. Okay,
And not a lot of people can save that kind of money. Like, it's just not foreseeable for somebody to save like a few $100,000 like that.
Right.
Yeah.
Imagine getting 300, saving, let's just say 300,000, okay, in 6 years. Who's gonna do that?
Right.
Yeah.
Nobody, right? Nobody. Okay, I mean,
Maybe buy a Bitcoin.
I don't know. I mean, I have Bitcoin. They're doing good, but they're not doing that good.
Okay, so Oliver, explain a little bit about that.
Millionaire, you put your shirt.
Okay, so
because you mentioned this, so she bought without a down payment.
yeah. So there are programs out there that can help a first-time home buyer. Okay, sometimes it's not even exclusive for first-time buyers. It may be somebody that had previously owned a home. Okay, see, a first-time buyer is defined as somebody that never owned a home for the last 3 years.
3 years. Right.
Okay,
Not a lot of people know that.
Yeah.
right. So if you have been renting or been living with your parents, okay, for last 3 years, and you used to own a home, if it's been 3 years, you consider a first-time buyer.
Yeah, those who have lost their home a few years ago, now they have fixed their credit. Their credit is now they revived from that. Now they can buy a home.
Right.
And still become home buyer.
Right. So I mean, it's wealth building.
Right.
Kind of going back to the start of your program, you've never seen a renter that that is a rich person that's a renter, right?
Yes.
I think Abby, you said that, right? So this is how you build wealth here. Okay, imagine no money down. She just used her good credit to leverage to get into home. I mean, don't get me wrong, okay? You can't just be have somebody that has bad credit and make money get into a house. No, the number one reason why somebody cannot get a loan, or at least I cannot help them, it's not because of down payment. It's because of their credit.
Yeah.
And she didn't make a lot of money, right? Like it's
Not at
not
all.
like six figures
Oh
or
heck no! Oh no! Oh no! That, like, for example, you know, I think I made a note here for that $500,000 home.
Mhm.
Somebody that's making, I don't know, 80 to 90,000 could perhaps qualify for that loan. That scenario I just gave you.
So it's
that's
definitely attainable.
it's less than like $50,000 each, right?
Right.
Yeah.
And it could come from, you know, what I've seen, okay, is could be husband and wife, okay?
Mhm.
And then they're gonna come in with the brother-in-law wants to be in also. So he puts in, he's gonna be part of the transaction.
And be a
So
co-borrower.
co-borrower,
Oh.
right? Now just
How
keep
many
in mind, okay,
borrowers can you have in a loan?
okay.
What's the
It's
most
a
you've
Filipino
seen?
thing.
Let me
Olive
ask you that.
Filipinos want to have like 5, 6
can
people.
have 5
Oh,
couples.
I've had 6. Okay,
You've had 6.
Wow.
Wow.
I've had 6. Okay, I don't know. I think you can have 10. I don't know, but personally, I've had 6, and it wasn't a fun thing to do. Okay, trying to juggle all these numbers, paperwork. Okay, so there's possibilities for you to get in. Okay, if you needed a little bit of help as far as income goes, you could have a co-buyer that's a family member that wants to get in. It could be a friend. It could be a fiance. That works too.
Makes
Mhm.
sense.
There are
But
programs that you can actually combine, right? You know, Oliver, we did some that were able to combine certain programs so that we can come up with a closing cost and some of their down payment.
right, you can do that. But like I said, okay, some of these programs have thinned out. Okay, they're not there anymore, or they're giving less. Some of them gotten a little bit more strict. Oh, by the way, okay, with these type of assistance programs, income is important. That you qualify is income based. Okay. Of course, I mentioned credit already, and they're pretty strict on the capacity, the debt to income ratio. They're strict on that too. Okay. But like I said, kind of going back, you know, it really starts with credit. It really
Yeah.
starts with credit.
So, like right now, there's a lot of millennials that are making good money, but then they don't have savings. So
Right.
what we have been experiencing most of the time now is mom and dad that has a fat equity on their home for the last 10 years would help, put in like $50,000 or so for the down payment. And because the millennial, their kid has a very good sturdy income and can qualify on the monthly payment, then with that, they can buy a house.
Yeah,
With
and it kind of, as I mentioned, that's leveraging. That's
Yeah.
Right.
leveraging your equity. You're not putting your eggs in one basket. Now you're putting it in 2 baskets. You're
Yeah.
leveraging the equity to get into another property, and then perhaps get into another property, and
Mhm.
imagine what you can do right now.
Yeah. Yeah.
I'm not a financial advisor, okay, so I don't know if that makes perfect sense as far as
Diversify.
building wealth, but to me it does. To me it does. Okay, it builds wealth, right? It's and that you can pass down from your generation to your kids, and who knows, maybe your grandkids.
Mhm.
Right.
Mhm. Yeah.
Yeah, just
Well,
like the whole premise of our show.
Yeah.
Right.
There's a lot of it's like a pizza pie. There's a lot of slices of different kinds of loans and different strategies and different terms that you can use if you have a realtor and a lender that can work for you and negotiate for you and find the best loan. Um, then you can go, make offer on different kinds of strategies.
Right, right. And as I mentioned earlier, okay, when I was trying to buy my first home, I was looking at, boy, I think I was looking at Carlton Sheets, okay. I was looking at Ron Gerald or something, okay. These are like creative financing, okay, to buy your investment property, and really all I needed to do was really to talk to a realtor, okay, and a lender, okay, see if they can find me the program that I need to get into my first home. It only takes one. I've always operated in that motto, I mean, it only takes one. Once I get my first home, now I could maybe get my second home, or maybe I can have a income property in my first, next home.
Right.
And that's true. A realtor and a good lender can definitely assist you instead of just going in blind. Like, oh, okay, what should I do? At least this way, you have a picture of like how your finances are and what your options will be.
Yeah.
Right. You want to
So we
let them do the heavy lifting.
Yeah,
Yeah.
we have to say in
Right.
our trade right now that, because of social media, you can always find a house. There's no problem. So many listings out there. But the bottom line is then, can you own that house? You
Right.
know, when
Right.
you want to own a house or you want to get a house, that's where a good realtor and a good lender is comes in. You know.
Right.
And
Right.
you guys, whoever's watching, you can send any of us a message, and then we'd be glad to assist you. And everything is confidential, and we're here to answer your questions and to help you with your real estate needs.
Yep.
Yeah.
Most
Absolutely.
definitely.
Yeah, and if they have somebody who has lender questions, yeah, just contact any one of these ladies, and I'll try my best to help you guys out.
Thanks,
I'm sure I'm not
Oliver.
you're welcome. I'm sure I'm not the only lender out there, so if I can help, I'd be glad to.
There's a lot of lenders watching right now too.
Yes. Yes.
They're watching you, Oliver. They're like, let me see if he's gonna say anything wrong.
Yeah.
Well, so there you have it. You guys can become a homeowner. Like Oliver mentioned, there's so many options there's a few options, I guess, between conventional and government-backed loans. But I know some of you guys are watching and you're thinking, well, what if my financial situation isn't exactly cookie cutter? We have
Yeah.
a few of you who are self-employed, you're independent contractors. Some of you don't have down payments,
Mhm.
whatever the case is. Be sure to tune in next week. We're gonna bring Oliver back, and we're gonna dive a little deeper into these CalHAFA loans and other down payment assistance programs, and other creative avenues like reverse mortgages and maybe some stated income loans. And other than that, if you guys have any particular questions, again, please feel free to comment or private message us direct. And I guess we'll see you all next week.
Bye.
Yeah.
Thanks for
Bye.
watching. Thanks for watching, you guys.
Bye.